Hi there. Welcome to this online lecture where I'm going to be talking a little bit about how to deal with variances. My name is Gareth. There's my email address, garethjohn@fi.co.uk. I'm a managing director with First Intuition, one of the UK's premier accountancy training colleges, doing a variety of both classroom and distance learning courses for AAT students. I also use Twitter quite extensively, so feel free to tweet me and get in touch and follow me at AAT Top Tutor. Over the last few years, First Intuition, we've had a very good run actually. We were Accountancy College of the Year for the UK in 2010 and 12 and 14, so even numbers, quite lucky for us. I was really proud to be awarded UK Accountancy Lecturer of the Year back in 2011, and we're also fairly recently nominated for Study Resource of the Year. So we're very pleased with that last few years. Well, we're going to look at a little variance example, and quite a wide-ranging one I've created here. It's only short and sweet, but gets us to think about quite a wide variety of the different issues you might see, both with calculations and discussion of variances. Now, when we're doing variance analysis, fundamentally, we're comparing budgeted results to actual results. Were the actual results better than we expected, in which case we might see some favourable variances, or were they worse than we expected, in which case we might see some adverse variances. Variance analysis is one of the key numerical techniques that businesses use for control of their business. Now you can see here we've got some budgeted and actual information relating to labour, and we're going to answer 4 parts to this question, starting with identifying some standard information for labour. Now standards are what we expect. I think of standards as targets that we're trying to achieve. If we beat the targets, we'll have a favourable variance. If we fall short of the targets, it'll be adverse. Now, because standards are targets, they would generally be set up at the beginning of the year. Beginning of the year, we're going to be looking at budgeted information. You can imagine that when we're dealing with our standards, we won't know what the actual results for the year are. That won't occur till the end of the year. So to work out standard information, we're going to use the budgeted data. You can see we're budgeting to produce 2,000 units using 6,000 labour hours with a total cost of £48,000. And in fact, I reckon that there are 3 pieces of standard information I can identify here. Firstly, we can work out the standard quantity of labour per unit of production, because we know that we're going to use 6,000 hours to produce 2,000 units. That is 3 hours per unit. I'm expecting every single unit here to take me 3 hours to produce, therefore 2,000 units will take 6,000 hours. So that's my standard quantity of labour, giving me a measure of how fast I think staff are going to be. If they take less than 3 hours, then I can identify that they're going to have a favourable labour efficiency variance. Something else we can calculate is the standard labour rate, because we know that that 6,000 labour hours is expected to cost £48,000. So if I take £48,000, divide by 6,000 hours, that's a standard of £8 per hour. That's what I must be expecting to pay my staff. If I end up paying more than £8 per hour, I think I'll be identifying an adverse labour rate variance. So you can imagine with the standards I've identified so far, the standard quantity, the time taken per unit, that's likely to be relevant to efficiency variances, and the standard labour rate, effectively the cost per hour, is going to be relevant to the labour rate variance. The other figure I can actually work out is I know that my 2,000 budgeted units was going to cost a total of £48,000. So I can actually work out a standard labour cost per unit. Remember that £8 we just worked out was per hour of labour. If you actually now take £48,000 over 2,000 units that we're planning to produce, you should get that coming to £24 per unit. And you can actually double check the logic of your numbers here, because if I was expecting every unit to take 3 hours, and I'm expecting to pay every hour £8, well, 3 hours times £8 per hour should give you the same £24 per unit. So that's the standard information I'm interested in here, based on the budgets that we were given. I can now start thinking about variances. Now, the first variance we're going to calculate is actually the total direct labour cost variance. We'll then look at breaking it down into constituent elements, but the total direct labour cost variance is effectively comparing the actual amount we spent on labour, which is actually quite an easy figure. We can see that we actually spent £43,200, but we're going to compare that to what we expected to spend. Now, the thing you've got to be very careful about here is we can't compare the £43,200 we actually spent to the budgeted figure of £48,000. We can't compare them directly because they're based on different volumes. What we effectively need to do is to flex the budget. Flexing the budget allows us to compare like with like. I can't compare the cost for 2,000 units to the cost for 1,800 units. Of course they're going to be different. So I need to flex the budget to account for the correct volume. So let's have a look at how we can do this calculation. So I'm going to work out the total direct labour cost variance here. And bear in mind, this has got to be based on the actual level of production. Remember, that original budget we were given was based on 2,000 units. I need to base this on 1,800 units that was actually produced. And what we're going to do is compare what that should have cost at standard to what it did cost in reality. Now, we know what it did cost. That's our £43,200. Well, what should it have cost? Whenever I think of a should is the standard. That would be our expectation. So for 1,800 units, well, what should that cost? Well, if I go back to the standard figures that we just calculated, well, I just need to make sure I pick up the right standard figure. Well, I'm looking at costs here. So, well, I've got two costs. I've got £8 and £24. Now, the £8 is per hour. I'm not looking at hours. I'm looking at units, aren't I? I'm looking at the actual volume of 1,800 units. So I think that the variance I'm interested in, I'm going to be using the £24 per unit. And at £24 standard cost per unit, I think this should cost £43,200. Now you can see in this case, it actually cost exactly what it should have done. So my total direct labour cost variance is actually nil. So overall, we spent bang on what we would have expected. Does that mean there were no problems? Well, not necessarily. Because although the total direct labour cost variance is nil, we may still experience variances when we break this down. And the way we're going to break this down is we're going to calculate the labour rate and labour efficiency variances. Now, what we need to remember is that the labour rate and labour efficiency variances, when they're combined, should always equal the total direct labour cost variance. And so we'll be able to see if that's the case. Now, when we're calculating the labour rate variance, this is looking at how much we're paying for every hour of labour. And so it's based on the hours paid to staff in the period. You can imagine if you're paying more per hour than anticipated, that will affect you for all the hours you're paying. Now, how many hours were paid here? Well, in actuality, there was 5,760 hours. And what we're going to do is compare what that should have cost, the expectation, that's based on the standard, and compare it to what it did cost. Well, we already know what it did cost. The did cost is, again, the actual cost of labour of 43,200. What should it have cost? Well, 5,760 hours. Remember, every time I see should, I'm thinking about the standard. And our standard cost, well, it's £8 per hour, because we're now looking at things in hours, aren't we? So now it's the £8 I'm interested in. I use that to identify my expectation. Well, at £8 per hour for 5,760, I think we should have spent £46,080. You can see we've clearly spent less than that. I think that's therefore going to give me a favourable variance. The actual amount spent was only 43,200. We've clearly not paid our staff as much as £8 per hour. And in terms of the variance, well, the variance is just a difference between the two numbers. And my difference here is £2,880 favourable on labour rate. So I've paid less than I expected to my staff for every hour that they've worked. Well, if that's the labour rate variance, what about labour efficiency? Well, the labour efficiency variance is based on the actual volume of production, because labour efficiency is looking at how fast staff worked to produce the units produced. In this case, the number of units produced was our 1,800 units. Again, remember, we do flex budgets. We're not too interested in the 2,000 units from the original budget. Well, I know how many hours that did take. That did take 5,760 hours. But what should it have taken? Well, again, should takes me back to my standard. Now, if you remember our standard quantity of labour, we were expecting each unit to take 3 hours to produce. So 1,800 units times 3 hours per unit gives me 5,400 hours that I'm expecting them to take. They took longer. They took 5,760. So I'm thinking we're going to have an adverse variance here. And the difference is 360 hours. That's an adverse variance. They took longer than expected. They were slower than expected. They took longer than 3 hours per unit. The thing you've then got to be a bit careful about is that that variance at that stage is measured in hours. Some variances, when you first calculate them, are already in pounds. So, for instance, the labour rate variance, we were comparing pounds figures, so we got a pounds variance. But when you look at labour efficiency, initially you're comparing hours figures, so you get a variance in hours. Now, we're always interested in the impact that variances have on our profit, so I always want to convert variances into pounds, and the way we do that is we typically value at the standard. So in this case, the standard cost per labour hour, which if you remember was our £8 that we worked out way back at the start of this process. And so my variance actually converted into pounds, well, 360 hours at £8 is 2,880, and that would still be adverse. They took longer than expected. That's going to cost me more money. So 2,880 is the adverse labour efficiency variance. And if we now think about how these two variances break down the total, if you remember, the total direct labour variance that we originally worked out was 0. Did that mean that there were no problems? Well, actually not at all, because we've now broken it down into a labour rate variance, which was 2,880 favourable, and a labour efficiency variance, which was 2,880 adverse. And you can see that if you combine the labour rate and labour efficiency variances, well, 2,880 favourable combined with 2,880 adverse, they would cancel off exactly, giving us the overall total direct labour variance of 0. But you can see that 0 total variance did mask the fact that there was a bit more going on here. Labour rate was favourable, that saved us money, but labour efficiency is adverse, that's cost us money. Now, this hopefully indicates why it's useful to break variances down. Sometimes the total variances can mask what's really going on below the surface. And we're now in a position to hopefully answer the final part of this question, which is to actually consider some reasons why these variances may have arisen. So why might we have got the favourable labour rate variance and the adverse labour efficiency variance? Well, start with the labour rate variance. The favourable variance, remember, meant we spent less than expected. So we were spending less than £8 per hour. Why might that have happened? Well, could be that we decided to use lower skill staff. Lower skill staff will generally earn less. So maybe we only need to pay them £7 per hour or £7.50 per hour. So maybe we made a decision to recruit lower skilled staff. It may be that in the business there was less overtime working than expected, because overtime will tend to be paid at a premium to basic hours. It's normally at a higher hourly rate. So if we work less of it, on average we'll be paying less per hour. Could be that perhaps we've started doing some of our production overseas. In some developing countries, wage rates are a lot lower than in places like the United Kingdom, so perhaps we're using overseas labour who earn a lower hourly wage. So there's various reasons why we might have got that favourable labour rate variance. The labour efficiency variance, though, indicated that staff was slower than expected. They took more than 3 hours to make each unit. Now that could have been, well, it could have been because of lower skilled staff. Lower skilled staff will generally be slower. Maybe they're going to take 3.5 hours or 4 hours to make each unit. Could be a lack of training of staff. If you don't train your staff, they're not going to have the skills to do their jobs properly. So maybe we've tried to skimp on training, and as a result our staff have been slower. Could be for quite different reasons, like maybe we're using poor quality materials. Now, why would poor quality materials affect labour? Well, poor quality materials are often harder to work with, and it may be taking our staff longer to make each unit because they're having problems with the material. Similar idea could be machine breakdowns. Imagine if the machines keep breaking down and there are delays and stoppages and time for repairs, it's going to take longer to effectively produce each unit. So there's a variety of reasons why we may have suffered these two variances. What's always particularly exciting is if we can link two variances together. And I think particularly because we've got a favourable variance on labour rate and an adverse variance on labour efficiency, there could be a very logical joint explanation, which we've actually already raised. Perhaps we did indeed make a decision here to use lower skilled staff. That would give us the advantage of being able to pay them less, so maybe we're paying them less than £8 per hour. That's giving us the favourable labour rate variance, but these lower skilled staff would be slower. They're not going to be as quick as our normal workers, so they're going to take longer than 3 hours to make each unit. That's going to give us our adverse labour efficiency variance. So it's particularly interesting if you can think of reasons why we might get both variances occurring at the same time. Well, I hope you found that interesting and useful. Do feel free to get in touch with me if there's anything you want to ask. Otherwise, have fun, and I'll see you soon.